Hello guys, welcome to Analog IAS Prelims 2020 special high yielding series. Today's economy topic that we'll be discussing is the external benchmark rate. In our previous videos, we have been looking at how RBI has been doing a lot of things to ensure that the rate cuts given by the monetary policy are passed on to the customers by the banks. So as we have already seen, banks cannot be forced by RBI to ensure that customers actually get the rate cut. So if we want to go by evidence, in February 2019, 6.5% was the repo rate. Now it fell by 135 basis points across the various bi-monthly monetary policy reviews, and in December it reached 5.15%. Yet, since there was no monetary policy transmission, previously RBI under Raghuram Rajan's era went for a concept called MCLR. Please revise this concept. This is a pretty old concept, and if you want a video, please do let me know about this. So after bank rates, many banks have moved to the MCLR regime to ensure that their marginal costs are recovered while lending money to different borrowers. So instead of going for repo rate, most of the banks are now stuck with MCLR concept. What is this MCLR? Like I've already told you, please revise it. If you want a video, do let me know. And if you take a look at this graph, this is SBI's MCLR in the month of September. So there is a clear gap of 2.75% with repo rate. So this 2.75% is the spread of SBI, and whenever there is a rate cut in this repo rate, the spread remains the same and there is no transmission of monetary policy. So it is in this context RBI wanted to move over to external benchmark lending. Before actually getting into the details of external benchmark, let us try to understand the concept of fixed interest rate and floating interest rate. Whenever a customer wants to take a loan, so whenever there is an agreement being made, the option will be of two kinds. Either the customer can go for a fixed interest rate or a floating interest rate that changes from time to time. So for example, if the customer believes that there is a possibility of higher interest rate and he does not want to risk paying more, he would go for a fixed interest rate of say 9% throughout his tenure. And once this agreement is sealed, he would continue to pay 9% for the entire EMI period. But if the customer feels that there is a chance of interest rates falling down due to any reason, he would opt for a floating rate. So this is the fixed rate and floating interest rate. So if the customer wants to opt for a floating interest rate, what will be the basis? That is the central question. The answer for that is external benchmark. So with effect from 1st October 2019, RBI ordered all the banks to go for external benchmark rates. Now what are these external benchmarks? Let me explain this concept of external benchmark with an example. Say for example, you want to buy a car and the rates are pretty cheap in an economy. So this will increase the number of cars in an economy, and therefore a rise in demand for petrol increases the price of petrol. So there is a correlation. So this rise in cost of petrol is decided by the volume of the sale of the cars. In a situation where cars volume falls down because of expensive rates, immediately the demand for petrol also falls down, and that is indicated by the benchmark, that is volume of sales of particular cars in this scenario. Similarly, in an economy, there are various points of references called benchmarks. Now let us have a look at what these benchmarks or point of references are. So basically there are 4 external benchmarks set by RBI. First one is the repo rate. RBI, or to be precise, Monetary Policy Committee comes out with a repo rate every 2 months. Bi-monthly monetary policy decides repo rate. Secondly, we witnessed the concept of bond yield in our previous videos. If you didn't watch that video, please pause this video right now and go back to that video. A simplistic explanation is, whenever the demand or price rises for a particular bond, the yield it gives will fall down because a customer is paying a higher amount of price for the bond and thus his yield is reduced. So please go back to those previous videos and see what this concept of bond yield is. So the second point of reference or the second external benchmark set by RBI is the 3-month treasury bond yield or 6-month treasury bond yield. Banks can go for either of these. And similarly, there is an organization called the Financial Benchmarks India Private Limited. This is set up under the Companies Act in 2014. So RBI recognized it as an independent benchmark administrator in 2015 itself. So what it actually does is it acts as an administrator of the Indian interest rate. So this bond yield is actually certified by this organization. Now the most important question that one has to ask is, can a bank decide which customer gets at which external benchmark indicator? Say for example, one class of customers will get cheaper loans, and in order to discourage lending to another set of customers, can a bank manager have a discretion to impose higher interest rate on a particular set of customers? No, actually, if you take a particular category, there should be only one kind of a benchmark. Say for example, if you want to take the 6-month treasury bill as an external benchmark indicator for lending for auto loans, that should be the benchmark for all the borrowers who are taking loan from the bank in that particular automotive sector. You cannot say that a person buying a Tata Nano car will have one sort of an interest rate and the other person who is buying an Alto will have another kind of an interest rate. The bank needs to impose a uniform rate for that particular category for all the customers. The second important question that we have to ask is this applicable for older loans? Yes, it is applicable, but the banks and customers must arrive at an agreement regarding this. Only then it will happen, otherwise it will not. So RBI has mandated that whenever there is a rate cut, within 3 months the bank must ensure that their rates are cut down. That is how RBI will be ensuring that policy rate transmission happens and customers get loans at a cheaper rate. Indian economy is marred by one important structural issue, that is high cost of lending. RBI is trying to address that situation with various measures like LTRO, Operation Twist and external benchmark lending. We have completed all these videos with respect to monetary policy transmission. Please go through all these videos and enhance your concept of monetary policy transmission. That's it for the day. Thank you.